Hello, everyone. Welcome. Thank you for coming to the show, to this presentation. For those of you who don't know me, my name is Omar Ayales. I write a weekly trading service analyzing macro trends for that you can use for your investments. Today, I want to talk about inflation. Even though many, and especially at the Federal Reserve, might think that this fight against inflation is done. We're going to go see some charts and some different data that could point to the contrary to that. So it's going to be an interesting road in the next 20 minutes. Okay, so one of the things that I think is really important, for all investors is to try to always understand the primary trend, where the direction of the overall market is going, okay? And then once you understand what the primary trend is, and by primary trend, I mean the trends are gonna last 10, 20 years, okay? Once you know what that is, then you can start setting up your portfolio, you can start making different decisions, you can start seeing in what companies to invest, what to follow, okay? Inflation, of course, is one of those big things that you wanna keep your eye on, especially when they do mega shifts, okay? So inflation moves in cycles, long-term cycles of 30, 40 years, or maybe sometimes even longer. The last time that we had an inflationary era, okay, was basically in the aftermath of World War II, and then all the way to 1980 when rates peaked. Okay, the reason why I'm showing these charts first is because I'll explain. Interest rates, especially benchmark rates like the U.S. 30-year yield, track inflation and inflation expectations down the line very accurately. So by understanding the movement of the interest rates of these benchmark rates, we're able to understand where inflation is headed and how we can time it for our personal needs. So basically, these two charts are the same thing. I just have one chart that is very long term, since 1930 all the way to today. And then basically the second chart here on the right is just a zoom out from 1920 to today. Okay, so basically ever since this up move is basically this is what it is. Okay, is a zoom in of this up move. Okay, so this is important because you can see as the interest rates move, the 30-year yield, particularly in U.S. and U.S. Treasuries. Okay, you see that around 1940. Okay, was this low, okay, around 2% on the 30-year yield. Then you see that for the next 40 years, basically, all the way to 1980, that rise in interest rates that went from 2% all the way to 15%, okay, that basically marked the rise of that inflationary era. Of course, everybody talks about from the 1970s because that was the last 10 years. That was when it went crazy with supply shocks and different things that were adding to it. But that trend had been growing for basically 30 years before that. Okay, then after it peaked, then it just peaked, and then after that, for 40 years, we saw rates decline with inflation. Okay, until they bottomed in 2020. Now, the 10 years before 2020, of course, were like zero interest rate policies, policies that are basically promoting a zero rate bound, okay? That basically bottomed in 2020. And very interesting, in 2022, okay, was that the 30-year yield broke above, see this red line? This red line is an 80-month moving average. It's a long-term moving average that I've identified here that captures this long-term move very accurately. So basically, you see in 2022, this red line was broken to the upside. And then in 2023, it confirmed it by staying above it. And you see, actually, more recently, it looks like it's probably going to be holding at this support level. What this is telling us is that even if we see a pullback in rates, as we have been seeing recently, it doesn't mean that the primary trend has changed. Okay, that shift in 2022 to higher rates for longer is still in place. It's still something that you should consider, and that is still very much real. Okay, I see a lot of talk about going back to a deflationary or disinflationary situation, and look, I'm not going to say that that's not possible, but the reality is that the likelihood of the opposite happening is real, is very real. Now, of course, these trends don't, like you see, they don't move necessarily completely straight up or straight down. they trend up over time and then they trend down. So of course you're going to have pullbacks and this kind of thing. But in the 30-year yield, if you want to keep a number in your mind, as long as the 30-year yield, well, it's very bullish above 4%, but as long as it stays above 276%, the 30-year yield, that higher for longer rates, that narrative will remain, will stay. And it's very likely that higher rates for longer will be with us for the next 20, 30, 40 years. This is just based on historical evidence. So a lot of people say, well, this is different. This time is different. It's so dangerous for you to be saying this. Well, this time is different when it's compared to the last 40 years. But compared to the last 100 years, it's not different. This is exactly what's meant to happen. Now, why? What are some of the reasons supporting this mega shift? How is it that what's happening in the world that's going to make us see these higher prices for interest rates? Okay, and these are some. I think I'm preaching to the choir and to many of you, but basically, you have a friend and nearshoring. Okay, that basically due to global fragmentation, that started basically with the situation between Russia and Ukraine and that division that created in the world, and how basically different systems have now been forged because of this. That is making different countries deal with friendshoring, right, with other countries that they feel comfortable with, and instead of maybe looking for I'm going to produce cheaper here, I'm just going to produce better here, even though it's more expensive, because they're my friends. They are aligned with me geopolitically and defense. There are going to be other things that are taken into consideration to develop these commercial relationships moving forward. And when you have convenience, okay, but convenience is expensive. Okay, it's not necessarily about building cheap or producing cheap anymore. It is about producing cheap, but also taking into account other elements like who you're dealing with. For example, one of the things that I believe that the West realized late in the game is that for the past 40 years, they have been contributing to the growth, for example, of China, which ideologically speaking, and in many ways, has nothing to do with Western values. And we've all of a sudden created this giant, and right now we don't know if it's an enemy, if it's a friend. I think that's basically a lesson that is going to push, countries now moving forward to look for, nearshoring, friendshoring, for their commerce. Energy transition. You can believe in the green transition or not. I'm not necessarily a believer in the green transition. I do believe that our energy demand is rising and it's going up very quickly. I do believe that we need to become, we need more different things, like more crude oil, more coal, more uranium, natural gas. We're going to need a lot of different things to be able to power our surging demand for energy. And this transition could be, moving a little bit away of maybe fossil fuels, because we're maybe like at a certain point there that we need maybe to start looking at other places. Uranium, for example, has been, nuclear energy particularly, but uranium has been one of those sources that the United Nations about a year ago even dubbed it a green fuel, okay, so that it could have space even with this green transition that many believe in. Sovereign debt crisis. Well, this is the big one, because it's not only in the US, it's not only in Western world, it's everywhere in the world. Everybody has a big debt problem, and especially the countries. Countries have big debt problems, and this is going to translate into higher prices just because of currency debasement. Okay, the loss of value of currency, of purchasing power of currencies, is going to contribute to the increase in cost and prices of commodities and services and goods across the board. War. There's so many potential scenarios of war happening in the world today. All of those are super inflationary. And you have of course, the Russian-Ukraine, you have Middle East, you have China-Taiwan, especially now with the recent election of somebody who's against reunification of China, somebody who's going to be more of a friend of the US, it seems. So all those things create tension, and that tension could eventually break out in international conflict. Emerging market potential. This has been a little bit of a laggard, particularly because of China. China has, of course, disappointed, and it has brought down most of the emerging market indicators or ETFs or whatever have China as a big part of it, and they've all done poorly because of it. But the reality is that within emerging markets, there have been pockets of performers. You know, you talk about India, you talk about a lot of countries in Latin America. You know, you're talking about others in Asia. You know, I do think that that trend of coming out of those pits is going to continue, and the demand that that can generate for resources across the board in a fragmented world where we have wars going on, we have debt crisis, debasing our currencies. You know, it's something that's going to also contribute to higher prices. Then, you know, when the shift in paradigm occurred in 2022, when basically the interest rates broke out from a secular downtrend, I was looking at different places for confirmation. Where can I look to see if, you know, this that has been happening? Where can I get confirmation from this? And actually, where I found it was comparing the price of gold and treasury bonds. Okay, and it's interesting because, you know, gold tends to rise, it tends to move with inflation, but more than that, it tends to move depending on where real rates are. Real rates mean basically the rate of inflation less a benchmark, a short-term benchmark rate. It could be the 90-day T-bill rate, okay? And then that, if that number is positive, then it's a real rate that is positive. And if that number is negative, of course, it's negative, okay? So gold tends to perform when real rates are negative or are very low in the positives. The past, since the rate hike cycle, the Fed started, you know, of course, real rates have stayed positive, okay? Now, that's shifting a little bit, is particularly with the Fed guidance. It's interesting because, you know, like a lot of people talk about Volcker, but really what we're setting ourselves up, or what the Fed is setting itself up more, is more like for an Arthur Burns type of situation, like in the 70s, where essentially what happened was, well, we think inflation is done, and then we start maybe easing, or we start maybe, you know, putting, you know, taking the foot off the gas as higher rates, and then all of a sudden, you know, inflation comes back up. Right? And then that's what happened in the 70s, and it led to it happened to Paul Volcker also, until he actually rose, you know, the Fed funds rate to a level where it basically crashed everything. But this confirmation is very interesting because you see that since the year 2000, so well, since the gold market was, say, liberated or freed in the early 70s to about the year 2000, okay, gold moved with interest rates against bonds. Gold and bonds would be moving in opposite directions. As of 2020, as of the year 2000, okay, that shifted, and then gold started moving with bonds, okay, and they would move together for the next 20 years. And it was in 2022, actually, that shifted once again. And then bonds, you see, you know, the bonds kept on falling. You see this line of 2022? While gold then all of a sudden surged, okay? So basically this divergence, you know, is telling us that gold is back to trading with interest rates rather than with bonds, okay, against bonds. So again, it's one of those things that people that, you know, whoever's looking at the market say, well, you know, what you're saying is dangerous because, you know, like, you know, this time is different. Well, it is different compared to the past 20 years, but it's not different compared to the past 40 or 50 years. The other thing is basically dollar weakness. The past year has, well, since November of 2022, basically the dollar. Okay, well, this chart shows both the dollar and gold, and I'll get into that in a minute. But just to talk about the dollar for a second, basically since May of 2021, the dollar and interest rates have been moving together, U.S. interest rates. Okay, and the reason for that is because the rise in the interest rates had to do a lot with economic performance within the U.S. There was this economic miracle that was happening in the U.S. You know, there was this excess liquidity, it's being spent, you know, out of COVID, everybody knows why, okay? But this was happening, and then basically that made the dollar stronger. Why? Because the dollar represents the whole economy of the US, okay? So if the US economy does well, the dollar is probably gonna be doing well. And this is in relative terms. Remember that this is not necessarily comparing the US to its ideal self, it's comparing itself to China, to everywhere else in the world, okay? But you see that since November of 2022, when there was already, like at the end of November 22, there was already a lot of talk regarding, well, maybe interest rates have risen a little too much. I remember a year ago exactly, my presentation was higher rates for longer. I was in a small camp saying that this was, I thought that this was going to happen. It ended up playing out this way. And then for some reason, it decoupled from the dollar. And, you know, the rates basically, have been coming down, but they actually they did break out above those November 22 highs, while the dollar, they had a little bit of a up move, but then it kept on falling. And then basically this is telling us that the dollar is basically in weak territory. Now it's still holding above very critical support. In the US dollar index, if you're looking at 99 to 100, okay, that is a very strong support level for the dollar. And if the dollar does not break below that level, I wouldn't count too much weakness for the dollar, not for too long, because the reality is that, it still remains strong, even though it's been falling for the past, year or so. Now, but when you compare it to gold, you see that, gold and the dollar tend to move in opposite directions, particularly since November of 2022. You see that the difference is very clear. Moreover, gold is looking like it's gonna keep on rising, which could be telling us that more weakness for the dollar is coming. So what does this all mean? Interest rates, inflation, this new inflationary era. What does this mean? Well, it means it's the end of easy money. It means it's the end of ultra speculative investing. Why? Because now money has a cost, and you're not going to see, basically the financial system finance ventures that are not delivering, returns, real returns. Okay. So I think it's going to be basically the end of some of that. It's going to be going back to basics, investing in what's real, search for real value that can sustain the test of time. Confirmation of a commodity, and it's a confirmation of a commodity super cycle. Okay, so what I mean when going back to basics, it means going back to investing in companies that maybe are producers of commodities or a producer of something. And this actually is very interesting because, like, you look at, for example, the top 10 companies, okay, that were the top 10 companies in the world in 1980. Why 1980? Because that was the end of the last inflationary era, okay? And then you compare it to the top 10 companies in 2022. Why 2022? Because that's the end of the last disinflationary era. And you can see, actually a lot of really interesting information. Some of that is that none that are in the list of 1980 are in the list of the year 2022. None, not one. And not only that, some of those in 1980 list merged together, which you would think that they were going to become, even bigger. And even then, they didn't make it into the list of 2022 of the top 10 companies. When you see the list of 2022, you see a lot of technology in there. Okay, you do see Saudi Aramco, and I put a little asterisk there next to it because I don't know. It's almost like, obviously it represents the entire production of crude oil of that country, and that in itself is significant. Okay, but it's basically the only one. And Exxon is not there, Chevron is not there, Texaco, they're not there. So Ford Motor Company, that was in 1980, they built a car, they built something that's real. It was there, at the end of this inflationary era that peaked in 1980. Okay, so it's very likely that over the next 20, 30 years, the companies that are going to be making up the list of the top 10 companies in the world then are going to look like the companies that were the top performing companies in 1980. They're not going to be the same ones. I'm not saying that, but they're probably going to be commodity producers. They're probably going to be commodities themselves. Well, as a top 10 performer, but the commodity producers are probably going to be in that camp. And I'm not talking just about gold. I'm talking about copper. I'm talking about uranium. I'm talking about crude oil. I'm talking about the resources that we need, okay, for to be able to operate the way that we do. So, talking about gold a little bit, where we are in the longer term cycles of gold. So now that we know that we're in an inflationary era, and now that we know that we should be looking to buy commodities, one of the commodities that I like the most is gold. The reason is that, of course, it's a hedge against uncertainty, it's a hedge against inflation. In this time that we are in this shift of paradigm, it's a safe bet. Okay, you can venture out with other things, but gold is going to be a safe bet where you're going to be able to have your money in, whether it's in gold directly or in some of the miners. Okay, moving forward. Now this chart basically is a long-term chart of gold. You can see that it's since 1967. Okay, it starts, and basically what I identified in red here is that ever since the gold market was liberated, okay, every 7 years or 8 years, it has developed a major bottom, the gold market. You see that here, 8 years during a bear market, 7 years during bull markets. And since the 2000 secular bull market, of course, it's been every 7 years. Interestingly is that the last major low of gold, okay, of the 7-year low, was back in November of 2022. Before then was December of 2015, which was an important key moment there for the Fed back in the moment. But this is telling me that for the next 3, 4, 5 years, we've already seen the lows in gold, the cyclical lows in gold. And it's very likely that we're not going to go below those. It's very likely, according to this chart. And even though those lows could be retested, but it's very likely that we're going to rise further. And you see that not only that, from every low, okay, from every 7-year low, an 11-year cycle stems as well. 11-year cycle with a peak, okay? So for example, the 11-year cycle that began in 2015, okay, it's poised to peak in 2026, 2027. Okay, and if you follow the chart back, I know that we're running a little bit out of time, so I can't really go in as much detail, and I can share this chart with you after. But if you go every 7 years back, and then also you take into account the 11-year high, you see that it's a very consistent cycle for gold. And right now, the lows that we're seeing in gold, currently, are just going to be probably some of the best opportunities to get into the space at the cheapest price over the next several years. So that's something to consider. Well, we see also uranium broke out, and it's off to the races. Look at this chart. It's just saying it's at a new high, and it keeps on rising. The leading indicator below is saying that it's very bullish and could rise for longer. Okay. Same thing with copper. Look at this chart of copper. Also, is a longer term chart. Below, you see a momentum indicator that is a proprietary. And you see that the indicator has been rising from lows, saying that momentum is picking up steam. This is telling us that over the next probably couple of years, also, a few years, it's going to be being in copper is going to be, or copper companies, it's going to be will be a good bet. Okay, for some of the companies that I like Ivanhoe Mines for copper, IVN.to. It's in the Toronto Exchange. I really like, some of the bigger ones also, like Freeport-McMoRan. Talk about gold. I really like Agnico Eagle. Right now, the senior mines, the senior names are so cheap that, you want to be able to get a lot of those in a portfolio because, yes, you're going to get maybe higher returns with the juniors, but you're also going to get a lot more risk. And definitely pay attention to the seniors, the Agnico Eagles of the world, the Silver Wheatons, or the Wheaton Precious Metals, WPM, AEM, those companies. For uranium, I really like Next Gen Energy. It's a Canadian company. NXE is the symbol. Great company. I didn't see it with the exhibits here, but they're a great company also to look into, and if you want to go into that space as well. I'll be around. I can't take questions right here because my time is out, but I'll be around here if you guys want to talk or chat or about any of this. Feel free. Also, if you want to write down my email, and you can send me an email. I'll send you these charts so you can have them. I'll also give you trial subscriptions to our letters if you're not subscribed already. Thank you.